Sure. Hi, I'm Tarana Lalwani. I'm a partner at InnoVen Capital. InnoVen Capital is probably the oldest venture debt player in the country. We started off as SVB back in 2008. And then in 15, Temasek and UOB of Singapore acquired the book and we rebranded as InnoVen. Collectively, SVB slash InnoVen, we've done over 250 companies. We have an active portfolio of 60 companies. We're sector agnostic. We're also stage agnostic because our check sizes range from as low as 3 crores to as high as 150 generally. And yeah, and I guess once we go into more details, we can talk more about what InnoVen and or venture debt is.
Hi, I'm Rajit Uboweja. I'm a partner at Stride Ventures. I joined Stride about 5 years back. I lead consumer and B2B commerce investments at the fund. Stride Ventures was one of the leading global venture debt funds with about 180 investments across seven funds and across 3 geographies. And yeah, we have offices across Singapore, UK, and India. Happy to be a part of this panel.
Hi, good morning, everyone. My name is Abhiroop Medhekar. I am the founder and CEO of Velocity. Velocity is a company that we started in 2020, and we primarily focus on working capital financing for digital-first businesses. We have funded close to 1,200 brands, primarily in the D2C and e-commerce spaces, and we have deployed over 1,000 crores of capital. Before starting Velocity, I was part of Elevation Capital, which is a venture capital firm. So also like happy to share my thoughts on VC versus the debt side. But we started Velocity because we figured that a lot of good brands are being built that are not able to raise VC capital, but they have good cash flows that we can understand and we can fund, and that's the gap that we address for them.
Thanks. I'm Aparajit. I represent Varanium Capital. At Varanium, I manage the alternatives business. Basically, we had a VC fund which is focused on fintech. We invested in a bunch of companies, including GetVantage, which is a revenue-based financing platform. From GetVantage, we realized that it was interesting to do package revenue-based financing as a venture debt solution for LPs. So that's what we've done. We do typically check size between 2 crores to about 5 crores with cash flow backing. So that's a bit about us.
Thanks, everyone. So I think the agenda for this session, what I'll like the panel to discuss and what all of you to understand is about why alternate investment is growing, what is venture debt, what is revenue-based financing, and finally to all the founders in the group on when is this useful for you all to raise venture debt. To start off, I think, Tarana, if you can start on why you have been in this industry for a long time. So why probably on the last 5 years, 6 years, venture debt and the alternative space has grown a lot. So if you can shed some light, that would be.
You know, so I've been part of the venture ecosystem in India, I think, since I first moved back to India, which was in end of 2006, worked with an early stage fund, and then joined InnoVen in 2017. And it's been interesting because I think at that point, I think InnoVen was the only, actually till 15, InnoVen was the only player. And then Trifecta came into the picture. And it's interesting, sort of, I think in some ways, you know, it was also, I think the venture ecosystem in India was nascent relative to what you see in the US. And so we just had to create an awareness of what venture debt is, educating founders, the ecosystem, what venture debt is. You know, there was a time when you could even say venture debt was more of a push product versus a pull product where, you know, you can say we were buy side and investors and providers of capital, but we were the ones going out there and sort of pitching what venture debt is and what the use cases and how to be used and why should one take venture debt. So it's grown. I mean, I think at that point it was maybe 3% of what venture capital fundraisers are. Today it's closer to 7-8%. I think between the four, you know, what you refer to as or categorize as the 4 true venture debt players, Altiria, InnoVen, Trifecta, and Stride, we probably deploy almost, I want to say, a billion, close to a billion, depending on the market environment, I'd say from 800 to a billion a year. And this was not the case, you know, 7 years ago. I mean, 7 years ago, barely, I think, 100 million, if anything, was being deployed in a year. So it's a function of venture capital or venture investments have grown, and we're a derivative of that. So venture debt has grown, as well as the awareness. Also more, second-time founders, the awareness has come, and sort of there's been momentum. So that's a little bit on sort of how venture debt has sort of created a mark. And alternative investments in general, right? Like be it revenue-based financing, private credit, that's also sort of gained momentum, just because also what happens is a lot of times banks unfortunately don't lend to the new economy businesses because they're loss-making. So what's the alternative to that? And that's where these sort of alternative debt products have come about. Also, as the market has evolved, what we're also seeing is a lot of people are doing now M&A acquisitions. Bank debt cannot be used for that. So that's another new use case that has cropped up for quote unquote private credit and venture debt in the last, I'd say, more so 2 years. So all this has sort of been catalyst to getting venture debt to sort of, I guess, has created awareness and hence, sort of more acceptance of the product.
Rajit, you want to build onto that?
Yeah, apart from the second-time founders, a number of VCs are recommending their portfolio companies to venture debt now because they now understand use cases like CAPEX, working capital, as Tarana mentioned, acquisition financing, the classic use case, which is runway extension and dilution prevention for founders and existing investors. All of the top 4 funds have raised sizable fund sizes of about $150 to $300 million and are doing deals in the range of about 50 to 200 crores. So actually, it's a very good alternative to pushing your equity round by, let's say, 6 to 9 months. And similarly, in the early stage, we have revenue-based financing as well, which use very interesting mechanisms to ensure the repayment of the debt and to help founders at the early stage. And I think Abhiroop can, of course, tell us more about that too.
Yeah. So Abhiroop, can you also build on what is revenue-based financing, and we'll come to then venture debt
Sure.
in a layman
So
terms.
see, I think the explanation lies in the name itself. It is revenue-based financing. We understand the revenues of the company. We need to track it. We need to understand the seasonality. We need to understand the margins. And based upon that, we are able to extend financing to the brand. We also set up collections on typically one of the core revenue channels, and that's how the repayment also happens. The gap that we at least saw in the market around 4 or 5 years back was the fact that if I talk about the D2C and e-commerce market, right? As of now, we have scraped a list of close to 10,000 brands in the country. And the VC-funded brands, people who have raised any sort of equity capital would be not more than 300. Which basically means that 9,700 brands are bootstrapped. They are being built on the back of their own revenues, on the back of their own cash flows, where the founders might have put in some money, where there could be some friends and family money. But that's a segment that is the counter of the VC-funded segment, right? And we felt that because they have online revenues that we can track, that we can see, that we can understand, we should be able to extend capital to them. And that's a product that we started. And that has actually scaled well for us because we believe that in India, a lot of brands are getting created which may not actually reach the VC scale, which can be profitable 100, 200 crore kind of companies. And these are companies that banks will still take some time to understand because they don't really have 3 years of profitability. They don't really have hard assets that they can give as actual collateral to the bank. And because of the fact that they have online sales that we can track transparently via APIs, we are able to fund them very, very quickly and seamlessly. So that's what revenue-based financing is.
Thanks, Abhiroop. Aparajit, you have been on the banking side as well, and now on this side as well. So if you can share some understanding on how banks underwrite versus how venture debt funds underwrite, it will help the founders to understand sort of the difference as well.
Actually, I don't want to discourage you, but if you go to a bank, you'll spend 3 months trying to get any money from them. Yes. I mean, even as funds, we go to banks and we sort of face enough of challenges going to banks. So banks are typically, because everyone who is sort of building businesses wants to build them with agility. Take, for example, a company, say, selling hats or caps online. Now, this company probably never raised capital, but is profitable. Now, the bank will say, show me your 5 years record, show me your capital infrastructure, show me machinery you have a factory, I need this and so that sort of adds to too many complexities for the guy. He's happy to pay slightly higher interest rate. So what ends up happening is, say, to make it simple, I'm putting round numbers. Someone's doing 1 crore of revenue a month and probably has a 60 lakh of gross margin and probably a 15 lakh of net margin after paying for marketing and all that. He or she is happy to pay, interest of say 2 lakh rupees per month on getting a 1 crore rupee loan. So he or she will come to us, take a 1 crore rupee loan, increase their working capital, increase the ability to stock up on various online platforms or on stores, and repay that 1 crore rupee. So what we will do is say, take 10 lakh rupee a month from, he or she may have a payment gateway account with say Razorpay. We will create a charge on that Razorpay account and take 10 lakh rupees for the next 12 months. So we get 1 crore 20 lakh back, say a 20% yield on our money, and the person gets 1 crore rupee very quickly. And basically they've paid an interest of 2 lakh rupees a month over the for 12 months, but they've got the money quickly and they've processed the transaction quickly. Actually, the speed is the important thing. From the date we get the application to the date we disburse is probably 7 days or 10 days, depending on how bad the documentation is. But typically we will approve it in 3 days, and then the disbursal will happen in 7 to 10 days. And that's the most important thing for the startup. They want money, they want to increase their inventory and revenue, and that's typically what will end up happening.
Thanks, Aparajit. And now maybe Tarana and Rajit, if you can come, I think what Aparajit was telling more on the smaller scale startups, and we guys actually fund a little on the larger side. So if you can share some thoughts on when a startup is probably ready for a venture debt, and what are the typical structure and terms like, that would be sort of helpful probably.
Sure. I mean, there is no set gating criteria, but when we speak about venture debt, a startup should be funded by an institutional investor already. It should not be pre-revenue. The leverage ratios should be in control. By leverage, I mean, let's say debt to valuation should not be ideally more than 5 to 7%, or let's say debt to equity raised till date should not be more than 15 to 20%. And some of these businesses, yes, would be loss-making, but they would be positive at a contribution margin level. That is, they are able to cover all of their variable costs at least. So we don't want to be in a situation where debt servicing is a burden for the startup as well. Sometimes, of course, one venture debt would be an exclusive partner with the company. And sometimes we work together as well because of these leverage ratios, about the total, let's say, risk appetite of a fund and the total debt requirement of the company as well.
So I think I'm going to tweak his points a bit. Ideally, venture debt should be playing a role in, like he said, companies that are sort of generating some revenue, and the thought process is that we play a role where banks don't. So technically from a Series A, where the sort of mortality is taken care of a bit, at least. You're not sort of an AI. I mean, I'm just throwing, since AI is the big thing now, where you're just starting out and no one knows anything, right? And you've raised 15 million. Should you be raising debt? Not ideally. But having said that, we all sort of play a role everywhere. So the ideal case is that you have some operational revenue, proof of concept, go-to-market strategy has been proven to a Series CD, because hopefully after Series CD, you potentially are able to get access to bank debt or cheaper debt. That's where, in a broad ideal world, venture debt plays a role. Again, like we said, it's, however, to his point, the two key criteria for venture debt, and hence the name venture comes from, is one, that you have an institutional investor in there from a governance point of view, that we know there's someone out there, they've done some sort of deep, they're there to sort of make sure things are all kosher. And two, that there's some sort of a runway expectation, because venture debt is not a bridge loan. We want to see at least 9 to 12 months runway, because the thought process is that the longer you stay operational, the more you can sort of service this debt. We're not a bridge loan. And I say that because a lot of time founders come to us saying, hey, you know, can you bridge us to the next round? And unfortunately, we can't. And it's a function, and founders need to keep that in mind, that when you're sort of struggling or in that sort of limbo state, you should not be raising debt. I mean, an early stage company or a late stage company, there's a certain, you should be able to have the ability or the visibility to service this debt. If debt can accelerate your growth, it can also accelerate your debt. So I think you have to balance that out. Yeah, which is why the leverage, but even, I mean, you don't want to, you know, and as debt players, we've all been responsible of sometimes giving debt to companies in the anxiousness of wanting to deploy. And so we're just as guilty of it. But as founders, I think you need to keep that in mind, that do I see visibility that I can manage servicing this debt? And of course, these are loss-making companies, generally cash flow burn. So it's not easy, which is why we sort of underwrite the equity and the business itself as well. So as a debt provider, you're wearing two hats. You're wearing a capital preservation hat, that can this capital come back? That's the first, you know, sort of to manage the debt piece. And then because these companies generally have money in the bank for 12 months, my debt is probably an 18-month loan, so there's tail risk. That's where I wear the equity hat, that, okay, what's the quality of founders? What's the business model? Are these guys going to be market leaders? Similar to an equity guy to underwrite my tail risk. So I'd say ideally you want to raise it when you've done some sort of proof of concept, but there's also different use cases. If you have a CapEx model, you know you're going to go out and be building a brick and mortar business, or you are a B2B business with working capital requirements, maybe raising a little debt with your first round doesn't hurt you, because it helps you sort of bring in discipline as well as manage your dilution, as Rajat said, because if you're going to be spending, you're raising 3 million and you're spending 750 to a million on capex or working capital, you know, there's a use case for it. Why not use debt, dilute less? Plus, it gives you a little bit of wiggle room to build your model. So that's sort of, I'd say, to sum it up, the time to raise debt.
Yeah, I just wanted to add, just wanted to add one more point to it, that sometimes people think that raising debt should be easier than raising equity. But if you deeply think about it, cost of capital, and this I tell to all the entrepreneurs, cost of capital in equity in the private side is typically 30%, right? Because you invest in a Nifty or a small cap index publicly, you expect 15%, right? So if you are doing a private investing on the equity side, you expect 30%, right? So that guy can take a lot more risk, right? Venture debt is probably half the cost of the private equity or the venture capital, right? So the risk is we are taking, the return we are getting is a lot lower. Hence the risk should be a little lower, right? So that's how the sort of the mental model to sort of think about it. Abhiroop,
debt, so
yes,
risk
yes.
appetite right there is.
So Abhiroop, now I think you have done a lot of investments on the consumer side. So if you can share few sort of subsectors on the consumer or on the broader economy, what is working for you, what is working for the ecosystem, and where do you expect the growth, at least for the RBF, to come from?
Yeah, sure. So see, I think we decided early that we should double down on the D2C and the e-commerce market. And as I think this was during the pandemic time when all of us were shopping online and a lot of brands were coming up, right? So it was a good time which saw a good ramp up of the business at our end also. We typically like sectors that have higher gross margins because we want to ensure that the repayments of the debt don't really hurt the business. And therefore, the kind of portfolio split that we have is indexed more on the higher gross margin sectors, which are beauty and personal care, health supplements, fashion, footwear, apparel, etc. We have some brands from the consumer electronics space also and F&B space also. But typically, those are lower margins. And in general, I think spaces like fashion, etc. have a lot of room for brand creation. And that sort of reflects in our portfolio also. The total number of brands out there in the market in the fashion space is quite high. And even in our portfolio, for example, I would say 25-30% of the portfolio would be fashion and apparel, including footwear, etc. In terms of where we see the trends going, where the growth is happening, one clear thing that is like an undeniable force in this market is the advent of quick commerce. We can see that brands that are getting listed on quick commerce platforms are seeing a 25-30% share of revenue coming from quick commerce within a 6-month period. And there's a long wait list of brands that are waiting to be listed on these platforms. So we believe that the consumer behavior is now shifting towards getting the products more quickly. And the brands which are able to do that, they're seeing a good growth. In terms of where new brand creation is happening, in my opinion, I believe that the home and kitchen space is a very attractive market, where as the disposable income rises, people want like more and more brands in that space also. And we don't really have a lot of big brands that have been created there yet.
Sure.
And that's a market that we are actively tracking.
Sure. Aparajit, you want to build onto it?
I think it's also seasonal. So you find that just before from June to like September or September, you have a lot of inventory build up for Diwali and festive season. So you'll end up finding that people who are selling say sweets online, you will see them a lot of ramping up their demand in say June to September. You will end up finding some apparel brands selling more in November and December. So those guys will. So there is seasonal cyclicality in each of these businesses across where they ramp up their this thing, and so you get an opportunity to do 3 month or 6 month debt also in those places, and you get repaid in 3 to 6 months because they'll wind down their inventory in that time also. So that's an interesting, and it reduces risk for us in the sense that it is a short term, so you'll get your money back much more easily.
Got it.
And it is through the APIs through a payment gateway. So that's sort of reduces the risk.
Got it. So on the shortest side, we understand the use cases and all. Tarana and Rajit, if you can, because venture debt is typically longer, anywhere from 18 to 36 months. So what are the sectors where we are seeing good growth and all? So if you can share few names briefly, that would be great.
Well, I think I think again, as I said, venture debt is a derivative of equity. So where the equity goes, we follow generally. And in the last couple of years, in the 2021 euphoria, every sector was booming and we were all deploying to all sectors. But in the last 2 years, I think financial services or fintech has taken, a lot of the lending businesses have had capacity. They've been, so we've put a lot of money there. B2B businesses, because again, they have a working capital requirement. So, why fund it with equity? We've funded a lot of them with debt. Of course, D2C has seen a huge sort of uptake. So we've seen quite a bit of deployment there. And interestingly, also to some extent, so I think those are sort of, I'd say, the three key sectors that sort of have seen venture debt sort of capital being deployed to. And of course, some consumer tech, which you can say D2C consumer. There we've sort of seen another use case. Also, what's happened in the last 2 years, interestingly, companies that didn't raise debt because valuations were being corrected, founders want to sort of defer the next equity round, they sort of came back on the table. So we ended up doing a lot of late stage companies where mortality was not constrained, or is not a concern rather, and so we sort of saw a lot of opportunity there as well. So I'd say, interestingly, in the last 2 years, it's not just about the sector, but stage of companies. A lot of late stage or growth stage companies have sort of been more open to taking debt because, they've sort of cut their burn. They sort of feel, okay, let me sort of get my model, put a little more, sort of prove the model out more so and delay my equity fundraise. So that's sort of where we have seen deployment.
Yeah, for us, in the past 2 years, around 30 to 35% of the overall investments have been in the consumer space. That is because two of the main use cases, working capital and capex, are super active in this sector. When I say working capital, means funding your receivables and inventory. We would ideally want to fund 75% of that using debt. And speaking about capex, it's not just on the manufacturing capacity side, but also on the exclusive business outlets expansion front as well. And in that, debt has been very useful for a number of companies where, so usually when you look at venture debt, it's the term debt kind of a structure where the end-to-end tenor is, let's say, in the range of 18 to 24 months. There is a certain payment holiday in the beginning when you're not repaying the loan. This could be 3 to 6 months. This is the time when, let's say, the store that a company has opened is not EBITDA level profitable. They're just servicing the interest at that time. After they become EBITDA level profitable, they start repaying the loan over the next 18 months to recover, which basically to cover the capex payback period. So equity is not touched at all to open these stores, and the store inflows are used to repay the debt as well as pay the interest. Uh, and as Tarana mentioned, that usually basically venture debt in a way follows equity as well. In the B2B commerce side, the equity activity has been very muted over the past 1.5, 2 years. And earlier it was one of our most active sectors. Now, I think fintech, there is clean tech, which has a lot more investments compared to B2B commerce. And even on the fintech front, the use cases are quite different compared to what I've mentioned earlier. Mainly it's for onward lending in lending businesses, or let's say FLDG financing in lending businesses. So there has been a shift, also in terms of the stages too. Now we're doing a lot of pre-IPO deals, like, for instance, in the consumer space, there are companies like Bluestone in clean tech, there's Aether Energy, Ola Electric, B2B also, infra market. Usually, venture debt was, let's say, a growth or a late growth stage kind of a product, which has reached the pre-IPO stage as well now. So that's what's happening over the past 1.5 years.
To wrap down the session, I have one last question to all the panelists. So basically what we have seen at Trifecta is that whatever we have deployed in the last probably 8-9 years, around 6,000 crores or so, delinquency has been probably at par with the best banks in India, the best retail banks in India. You'll know who's the best retail bank, and the NPAs are probably at par with them. But what we have seen in the last 2 years or so, there has been a lot of macroeconomic changes, the funding activity has sort of come down. So where do you think the risks can be seen from an ecosystem perspective with respect to venture debt and alternate investments? Maybe Aparajit, we can start with you and we can take a turn.
So I think in the revenue-based financing, the way we look at it is that we get funded through the margin itself. We will not do companies where the CM2 or CM3 is less than 15%. So is net before the office overheads or the central overheads, the company is sort of making a 15% margin, out of which 2% we keep as interest ourselves, and the rest we sort of, so that is the structure. So we've typically ended up in a company, the portfolio company we've invested, they've done about 2,100 loans, of which about 28 are bad, broadly 80 basis points gross NPA, net NPA of 20 basis points. That's been the case for the portfolio that I look at. So that's generally been where we are, because you also have cash flow management and taking money from a current account, escrow account mechanism. So that's the case that I have at hand.
Yeah, Abhiroop, if you can.
So, at least for us, we have always been quite conservative when it comes to extending capital. And I think, like in venture debt, you guys also explained, our analysis also is primarily trying to answer the question that will we get the capital back or not. And that we typically ensure that we have collectibles on the cash flows of the brand. And that typically leads to 90% of the collections happening on time. Typically, remaining 10% will go towards the bank, NASH, and all of that. But when we talk about par 90 delinquency, that for us will not be more than 1.5%. And I think that's the kind of delinquency that the portfolio can sustain, given the spreads, etc., that we have. So we aim to maintain that. And beyond that, I think we also have a good collections effort to ensure that we are supporting the brand to like come out of the situation that they might be in. Typically, it is driven by seasonality. Typically, it's driven by like a short-term fluctuation in the cash flows. But a lot of those brands are able to come out of it, and then we are able to support that again. Yeah.
Sure.
Even when you look at venture debt, so this is senior secured debt. We have a charge on all of the assets of the company, right? And it's not just limited to, let's say, having a legal recourse on the company. The venture part of venture debt is that there is a relationship with the founder, with the investors. You work together with them. And since you are at the, let's say, the top of the waterfall chart, it's not that difficult to recover the money, even in a stress case. And there are certain covenants that are in place. There's certain security that has been built into the structure. Using that, I mean, there are signals of, let's say, of an orange flag or an amber flag 6 months before a stress is visible. Using that, you can reduce the exposure in a certain company.
So I think it's again, I think market dynamics where I think the learning to me at least is there was a era where I think venture debt delinquencies were very low. I mean, when it was exceptionally low, we were, and I think it's a function of luck. It's a function of what the environment was, where equity markets were booming and equity flows were there. I do think as debt players, all of us, but maybe in particular venture debt, given we don't really have hard assets in most of our companies, the delinquencies are going to go up. And I think we as venture debt players have to be a little more cognizant of the fact that we don't, venture debt has been guilty of underwriting equity versus the business model, more weightage on the equity versus the business model. And I think that needs to change and is changing, where we're underwriting the business model and not equity anymore, or the institutional investor, which is only fair. So I think we'll see where it goes, but like Sahil said, delinquencies have been low, and I think it's been a function of, as I said, market environment, but also sort of figuring out how you structure the loan. And that, I think, plays a key role in how these sort of NPAs are managed.
Yeah, no, thanks, Tarana. So thank you all for sharing your views and insights, and hope the audience got a hang on what is venture debt, what is revenue-based financing, when do you want to take it. And thanks for being a patient and attentive audience. And probably we can just wrap it down. Thank you, everyone.